this episode of Straight Talk, we explore how older investors may be able to navigate their way around the post-annuity world of retirement planning using equity income orientated investment strategies. With us in the hot seat is Ben Davies from hedge fund Hind Capital. Lawrence.
David.
I want to talk a little bit about the kind of the post-annuity age, really, our new age that we live in. Yeah.
Yes.
Where you may not have to buy an annuity. Well, you don't have to buy an annuity.
You don't have to.
No, but you may still end up choosing to buy one. But unlikely. And I suppose what this opened up is the prospect that a lot of people are effectively, say you're 65 and you're thinking, or maybe you're approaching 65, you're thinking about how to generate a sustainable income over the long term. And I think the good thing about we talked about this when we did our budget program, the good thing about the annuity reform is, of course, it gives you a lot more choices now. You've always had them. I mean, you've always had income drawdown anyway. Yes. If you do it through SIPs, for instance, you can do an income drawdown anyway.
And you've had an element of choice through open market options. So rather than going with the pension provider and its annuity, you could shop around.
But now the choice is much, much bigger. You don't have to just do an annuity. You could do fixed income securities, you could do bonds, and you could do equities. And what strikes me is that it comes, that whole kind of post-annuity age comes at an age where the traditional route you'd go down, which would probably be fixed income, i.e. bonds, and let's be honest, bonds sit underneath annuities really anyway, gilts. It comes at a bad time really because, I can't, if you were looking around for a relatively risk-free asset that yielded quite a bit, bonds would not be high up my list, i.e. they do yield a decent amount of money, even corporate bonds, investment-grade corporate bonds, I don't know what, 3%, something like that, but they're not great. They provide a huge amount of income, and it can't really be said to be risk-free.
Absolutely not, no.
So fixed income, though has its attractions, because it is less volatile, is not the obvious slam dunk that I would have thought it would have been in the kind of the world of the post-annuity pension, which does open up the whole world of equities. And I think that's what's really fascinating now. If you just sat down with somebody and said, 5 years ago, 65 years old, you don't have to buy an annuity, and you could buy equities, they'd have looked at it like you're a crazy man. But now it's changed.
It has changed. It will change. I think the other side to think about as well, alongside equities, is historically a lot of people have used your classic blue chip UK listed equities to generate an income because of the dividend, and we've seen a huge special dividend from Vodafone this year.
Huge, yeah.
You plough back a couple of years and BP and the Gulf of Mexico, the dividend there got cut rapidly and drastically. So that knocked a big hole out of people's sort of portfolio. So, absolutely there is a place for equity income and dividend generating investments in retirement. But I think probably what people need is some form of sort of certainty to go with that income.
Absolutely, and that brings, because what people want is they want the classic. They want to have they'll have their lunch and eat it. They want the income that equities can generate. So it is not inconceivable that one can put together a decently diversified portfolio of reasonably largest equities that yields 4 or 5%, but they don't want the risk that goes with it.
Yeah.
They don't want the drawdown. That's the great thing about fixed income securities, though they are not risk-free, they are less volatile. And what's interesting is I talked earlier on today to a fund manager who's obviously spotted this opportunity, which is this kind of post-annuities world where people are looking for a more active management in the whole equity income space, i.e. generating an income, sustainable income, by investing in these dividend-orientated stocks, but with some control of the downside. And what's so fascinating is that he comes out of the hedge fund world. And traditionally, you just thought the traditional asset managers would be all over this, because it's what they do. But actually, if you think about it, although hedge fund sounds like, they're all traders, masters of the universe, actually, all good hedge fund managers have always thought about absolute returns. And what's so interesting is that I talked to Ben Davies, who's from a company called Hind Capital, and they're bringing out effectively an exchange-traded note, which is a bit like an ETF, but just slightly different structure, which is effectively a very actively managed equity income strategy, which actually they're trying to pitch at the kind of post-annuity world. So this is what I said. I caught up with him earlier. Ben, now Hind is traditionally perceived as a kind of gold hedge fund orientated outfit. You really know your way around precious metals, basically. Why are you doing an equity related product?
That's a very good question. I think the auspice behind why we set up Hind Capital was primarily we wanted to protect people's capital, but as monetary policy has become somewhat unconventional, as we would say, and
ever so slightly,
and fiscal policy, perhaps trying to address the fiscal drag. Clearly, we're in a ZIRP or a low interest rate environment, so savers have been deprived of income, and it seemed logical from the conversations we had with our client base, which really is institutions, family offices, and high net worth, and of course sophisticated retail, that they were desperate for income, but they didn't want that drawdown that potentially came with the debacle, not potentially, did come with the debacle of 2008, and is very much still inherent in markets today.
So we'll come back to that, because that sounds like you're almost trying to also address the kind of post-annuities retirement kind of pensions conundrum. So so let's just understand what you're doing. So effectively, you're doing a UK-focused equity income. So effectively, you're really focusing on stocks that produce a high and sustainable dividend, but you're doing it in a very active way. Do you want to talk us through what you're doing?
Yeah, so we've brought an exchange traded product.
Technically, this is an ETM, exchange traded note, is that right?
Yeah, that's right. Ultimately, as assets are raised, it will probably turn into an exchange traded fund. Okay. There's ostensibly not too much difference between it, except there is an element of credit risk with regard to SocGen.
And they're the people who are doing it. Societe Generale are sponsoring it. It's their channel, but it's your fund.
Yeah, so we've joined forces, for one of a better phrase. We're bringing the smarts on the strategy side, and they're bringing the smarts on the structuring side. And ironically, these products have been labelled Smart Beta. I think it's a bit of an elusive title. What Smart Beta ultimately means is it's quantitative rule-based strategies, and typically they're sort of equally weighted. We can talk about this a bit later, but to answer your question about what we're doing, it's a equity income strategy it is dynamic. We're looking for stocks that are out of favor relative to sector or index, that have a propensity to pay a dividend out of cash flow over a number of years. They've ostensibly got good balance sheets, they've got good profitability ratios, highly capitalized, very low debt, and it could be an event risk, it could be a cyclical event, a cyclical period, it could be just negative sentiment that would put these stocks out of favor. And we create a basket of 10 sort of FTSE 100, 10 FTSE 250 stocks, and against it we sell what's called a beta weighted 50% hedge, thereby mitigating some of the drawdown that is inherent with a marketplace at any point in time.
So effectively you've got a hedge going on. It's not 100%. Is that basically because you're at 50% because fundamentally I imagine it was cost? Yeah,
the cost is you obviously got to borrow on the hedge in terms of just sort of funding, although that's relatively low at these SONIA rates. But also you're giving away the upside potential. What I really love about our product, and we really are very proud of it, and individuals are, as a firm, we invest in our products. So we put our money where our mouth is. What I love about it is that not only are we reducing volatility through the hedge, we're providing a cushion of a relative income. Now that you could say that's not very much different from a passive income fund, except we're quarterly rebalancing equally weighted stocks. So you're mitigating the whole market capitalization issue that brings you into you overweight the large stocks.
In the market, that's traditionally you've been overweight BP, and then suddenly the dividend crashes.
Yeah, and it's much harder to ascertain sort of real alpha from a strategy. But I actually think we de-risk by the fact that as soon as a stock, let's say it captures a large percentage of the dividend in one quarter, we particularly screen for that relative to another stock, and then it re-rates back against the index, we will rotate it out. So in many ways, we're taking money off the table all the time. And that's the dynamic active bit, which I love so much. For me, we're bringing hedge fund-like strategies. Yeah. And with the help of SocGen, we've just effectively made them low cost, accessible, and liquid. And I think this is the evolution for the hedge fund into sort of fund management space.
Interesting. So you mentioned Smart Beta there just a second ago. I mean, we've seen a lot of this Smart Beta is this kind of catch-all term. I think you're quite right when you say it's effectively a way of taking quantitative rules and applying them to indices. Yeah. But yours, I mean, in a sense though, you've moved beyond Smart Beta, because effectively all Smart Beta would do is they might go, look, we'll screen the market for the highest yielding bunch of stocks, and then we'll stick them in an income orientated index. But you're going beyond that though, aren't you? So this is smart beta plus. Can you have that?
Yeah.
Even smarter beta. Or even active smarter beta.
Look, I'll be honest. I hate the phrase. But everything's about, as we've discussed many times before, branding, being able to label something. Fund managers, in my experience over the last 20 years, everyone, the compliance guy to the guy who's doing due diligence on funds, to the fund manager, they want to pigeonhole products. And obviously it's a very competitive space, so somebody's come up with this title, Smart Beta, which is probably reflective of what is actually happening. I just look at it very simply as we're trying to find smart solutions for investors today. And we are very flexible. We listen to what people say and we try and structure it. So for instance, we're looking to potentially do multi-asset income ETPs. That's sort of our next project. We can do this same strategy for Europe. We can do it for MSCI Asia. And if there's the appetite for this one, that's the iteration that we're going to get. And I apologise. What was exactly the question? That
is it smart beta?
Is it smart beta?
It's really active
It's
management.
next generation smart beta. Let's call it that. Let's call it that. All I'm trying to do, or what we're trying to do as a firm, is bring hedge fund like strategies, absolute return type strategies, and marry it with long only strategies, and just take the best of both worlds. Get some of that upside lift, try and mitigate some of the risk, and but an acronym I prefer: KISS. Just keep it simple, stupid. There is nothing overly complex about what we're doing. It's definitely a sort of bit of a Coca-Cola formula. I think I could give you the ingredients, and there's no way you'd be able to replicate it because I wouldn't give you the sort of the concoction or the mixture weightings.
But you could probably guess what the broad outlines of it are. We're real focused on balance sheet, cash flow, dividends.
There's only so many ways to skin a cat.
Yeah.
But we spent 2 years working on this project, and it gets to a point where you do beta test, and then you go, I'm happy with this product, and that's where we're at. And there'll be minor tweaks, as you have to always be cognizant of changes potentially in the market. But in reality, equity income investing in general is a great strategy throughout the last 100 years, and we've just done a variance of that.
And just about so we understand, the ETN itself is a total return ETN. So it's not paying out an income. So effectively, you are taking your returns out of the total return. So it's a total return index.
Yeah, so it's accumulating it. So it's reinvested and it's a capital. So the tax wrapper ultimately is CGT.
Yeah,
which obviously is in the UK is 28%. When we go to the ETF version, we will do a distribution and an accumulation. Other than a lot of the people who will be utilising this product, actually the CGT will work out better.
I was about to say most out for them.
So you could just take a draw. You could liquidate X amount.
And in fact, I'll come to that because it's about pensions really in a second. But I mean, if you were to run it in a pure income version, what would the average income yield be over the cycle?
Well, that's a fantastic question because, as you can imagine, in 2008, as prices dropped, yields went up demonstratively. If you look at it just from the long side and the total return side, then the average income, I would say, is probably over 5%.
Okay.
It's in that region. Now, what's very key is we're not buying companies. Choosing a stock based on its dividend, as you know only too well, having written a book about it, we are clearly have to be worried about the fiscal side of a company.
The balance sheet.
Yeah. It's all about the balance sheet. You have to look at the payout ratios. You need to look at sort of effectively what's coming out of cash flow, not earnings. And certainly we're buying stocks that have relatively high, and that's the crucial comment.
But
dividends
not
relatively
too high,
but not too high.
Yeah, you don't want
this
the
is
value
not
trap.
a high dividend stock picking.
So in effect, your total returns are coming from three elements really in the ETM version. They're coming from the underlying income yield, which is somewhere around 5-ish. They're coming. I imagine you're looking for some capital gains because you're looking to buy in reality beaten down stocks that, to your point, they might have been event driven and hoping to maybe make some money as the market begins to realise.
A great example would be something like Centrica at the moment in the utility sector.
Everybody hates it at the moment because they think
everyone hated. Another one would be recently ICAP. Everyone hated LIBOR scandal, voice brokering versus electronic brokering, etc., etc.
So kind of end driven. And then I suppose the last crucial bit people sometimes underestimate in the structure is it's a reinvestment strategy. So again, reinvesting both the capital gains and the income back into it, of course, is the smart thing to do for the long term.
And that provides a cushion and, as you know, the total return acceleration if the market picks up, because you picked up a lot of stock at cheap prices.
Last thought here, I mean, this sounds as though, I mean, you probably got a very strong view on this. I mean, the government's now liberated the pensions market.
Power to the people.
Power to the people. So you can now go out and buy your own Lamborghini.
We are trusted with our own money.
Exactly.
Finally.
Great, and presumably we're going to see a big rush now for people to basically provide kind of post-annuity like retirement or pension solutions. Do you think it could this ETN and hopefully the ETS could be useful for that group, which is a very big group with lots of money, let's be honest?
Yeah, I mean, there was a little bit of a whoop around the office
when it came out.
There's really excited from the standpoint of providing a product for investors first and foremost. But, we're capitalists at heart, and we see a huge opportunity as a business to coordinate with the big names in the industry and say, look, we can provide solutions here. You need drawdown products. Clearly, when you get to the age of 65 now, I think it's very interesting. People are going to need advice, and they're also going to, I suspect what's going to happen, the single annuity business is going to collapse just like the US did and Australia. If you look what happened there, it went down by sort of 75, 80%. So let's say in any 1 year, it's 12 billion now. It's probably go down to 3-4 billion. Now, for some of the players in the space, they can pick up earnings, if you like, from bulk annuities, which is where you get the transfer from defined pensions off company and de-risking longevity risk, etc., and giving it to the lifers. They're going to need a new form of products, and I think that's going to be drawdown products. And you'd be amazed how many don't have these. Perhaps don't even have the wherewithal to create them. Why not sort of get off the shelf, if you like, solution that we could be providing. Two, I think there's a real potential for multi-asset income funds. And if you can provide that in an ETP, I think that's very exciting because it's very low cost and highly accessible to lots of people. And I would have thought the pension industry should definitely look at that. So we want to get in there and provide them with those products.
Thank you very much, Bill.
Thank you very much. So
what I think is quite interesting is, in this post kind of annuity world for pensioners, also is to think about taking an income in unconventional ways. Let me explain this. So, for instance, their fund, the one we just talked about, is a total return one. I think he said that actually, if they end up having an ETF, they may want to have an income version as well. But it's a total return version. But what that reminds you is you don't have to just rely on the income. And I think you want to rely on the income generated by dividend-orientated companies. But what you might do is take a total returns version of any investment, in fact, in equities, and just simply top slice down, because actually that way, if you've got money outside, for instance, of a pension, you can take it as capital gains, but it doesn't get qualified as income. And I think that's quite interesting, which many pensioners forget.
Well, also, I think if you follow the world of funds like I do, some of the best so-called high income equity funds actually run as total return funds. So, Neil Woodford, who has been a sort of investigator perpetual for a long time, is now setting up on his own.
Literally,
his fund is called High Income. It's only because the income it generates is 50% more than the index does. The actual amount is 3.5% to 4%. It's not a very large number. But he achieves a much higher total return. So as an investor, if I was invested there and needed the income, I could do with what Ben was talking about, which was take a stream of income, plus I can take some of my capitals, use up the capital gains limit I've got every year. So again, you're right. This is probably an increasingly interesting strategy we'll hear a lot more about.
And what I think is fascinating as well is that so many pensioners don't think about that capital gains tax. Because the thing is, you get your income paid out by a pension, it's taxable. It's because it's income.
Yes.
I can't remember what the capital gains limit is now, but I think you can take the first 10,000 or something roughly like that as free of tax. So in fact, if you're canny about this, You can, in fact, what you do is you invest more money at the beginning in your total returns product and then just sell down some of those to get to your capital gains limit.
Yeah.
And then you take the rest as income.
Well, yeah, you know, without getting into people's individual tax situations,
Yeah.
I mean, you know, £10,000 capital gains tax, chances are you could be selling an asset that that gives you a sort of £20,000 lump sum for the sake of argument. So you can actually, as you quite rightly say, you know, generate a real income to yourself as an investor through this mixture of capital gains and income from the underlying investment.
Do you think, as just the last question, do you think that many people in the kind of post-annuities pension world, do you think they are going to start diverting money to equity-based products?
Well, I hope they do. I mean, I'm a little nervous about the sort of rash of buy-to-let schemes that are being positioned towards this market. If I'm a 65-year-old pensioner who's never been a buy-to-let investor, probably the last thing you should do is put a big lump sum into a rental property.
I agree.
But I think, you know, we are seeing the re-emergence of the equity income funds. They used to be the bedrock sort of 10 or 15 years ago. I think we've seen them coming back, and I think a lot more money over time. And you probably do need to take advice in this market to find the right ones. But I think, we'll see that coming back.
And interesting, what we might end up with is that, and I always thought it was a bit odd that you know, so many people, when they sit down with their professional advisors, they say they're 65, and the advisors will quite often say, oh, you need capital preservation, absolutely, and therefore only invest in cash or very low risk fixed income securities like gilts. And I think the penny's begun to drop now because of those longevity numbers. You've got to basically, and if you're definitely not having an annuity, you've got to make that income eke out for the next 17, possibly 20, possibly longer. 20, 25 years, actually, if you're an older, wealthier investor. And you've got to basically have to take some risk, maybe a small amount of risk, controlled amount of risk, in order to generate enough money. So we might see even a change in the asset allocation models for kind of post-65 advice.
Absolutely, and we can come on and talk about sort of risk in retirement from investments in another programme.
Absolutely. Thanks very much, Lawrence.
Thank you.